Hello everyone and welcome back. Thanks for joining us here. You wait 2 months for a BKL webinar and two come along within weeks. So joining me today, Anthony Newbrosh, to talk about yesterday's budget. It's Chris Smith, Head of Private Client Tax here.
Hi everybody.
And Terry Jordan, who does a little bit of trust and inheritance tax and lots of other things here. Hi Terry.
Good afternoon everybody.
Right, so we're going to spend the next hour talking about the budget. As always, we're very grateful for your thoughts, comments and questions. So feel free to type away in the Q&A section there. We'll try and deal with what we can during the webinar. If not, when we send out a copy of the slides to you all after we've finished. If there's any points we haven't managed to pick up, we'll do our best to cover them then. If not, of course, speak to your normal contact here at BKL. So that's enough on the housekeeping. Before we dive in, just a few other thoughts. That's us, still as good looking as ever, I'm pleased to say, everyone. About us here at BKL. It's been exciting times here, lots of changes. Delighted to be joined by our colleagues from Landau Baker, FSPG, CF Pro. Welcome aboard all. Now up to 270 of us here at BKL Towers in North London. That's 27 partners and we're a top 50 firm. Over 30 members in our tax team, so we are well placed, we hope, to assist you on anything that's come out of the budget or any other matters. And we're also very proud to be a B Corp, which means we're pretty good people, help people across the road, etc., etc. So that is something we will continue to invest in the future. And I can also officially welcome aboard Alan Haywood and Co, who joined us in the office here this week. Welcome aboard team. They specialise in music, media and entertainment and have brought another 2 partners to BKL. So we'll be seeing all of them soon as part of the BKL family. And we're not stopping there. Oh no, all I can say is watch this space. And we're also delighted to have won a couple of awards this year. We are at the Tolley's Taxation Awards, Best Employer in Tax, and in the Accounting Excellence Awards. Chris, I think you had the pleasure of receiving the award for Tax Team of the Year, did you not?
I did indeed.
You did. And if you want to see those trophies, they are in display at the Spurs Trophy Cabinet Room. You can't miss them, so feel free to pop along and have a look there. But enough, I guess we should talk about the budget really, shouldn't we? What are we going to be covering today? Well, we'll talk about the personal tax changes that were announced yesterday, in particular, the new rules covering non-domiciles and the related IHT changes. A few important changes on property tax we'll pull together and also just highlight some of the main implications for business tax. It's been quite difficult, hasn't it, Chris, because there's changes that have flowed through from previous years, but we're going to focus very much on what was announced yesterday. But from your perspective, any particular surprises?
It's an interesting one. Honestly, we were expecting the national insurance. That was all highly reported. I guess the furnished holiday let that we'll come on to a bit later, weren't expecting that as a big hit. A few little niceties with the child benefit, bits and pieces there, which again we'll touch upon. But overall, I wouldn't say, obviously we've got the big one coming up with the non-domiciles and we'll talk about that. It's obviously going to be a huge change, but no real major impacts. It maybe could have gone a little bit more given with being the political aspects of this budget.
Yeah, I was going to say it clearly was a political budget with the next election looming large in mind, and the key message the Chancellor kept highlighting was lower taxes. We're not here, obviously, we're not here to talk about politics. That's not what we do. But Terry, anything you particularly liked or disliked? Anything that you thought would be in that wasn't in the budget?
Well, I'm particularly pleased for my children, especially my daughter, who is the mother of 2 young children, and she and her husband are assistant head teachers. So the changes to child benefit should benefit them, and also the reduction in NI. Nothing at all for old people like me who are teetotal non-smokers, I'm afraid.
Okay, and on that note, okay, let's start with the personal tax changes. And obviously that covers the changes on domicile and residence. Let's just have a look at some of the headlines. Chris, take it away first.
Well, I mean, we started off with actually what didn't change. So the changes that didn't change as such, the personal tax rates still there with no change to the personal allowance, which has been fairly consistent now for a year or so. And that's obviously that's being reported at the moment with the drag that's going to bring more people into tax. So it's effectively a tax increase for some people, but we knew, we was expecting that not to move. The one, again, a bit of a surprise, completely new, the £5,000 allowance for the ISAs, which is going to be specifically UK equities. Will that give people incentive to put into an ISA? Don't know. Are people that confident on UK equities at the moment? Don't know. But it's a pleasant surprise, I guess. It gives that little bit of extra allowance that we can put away. And of course, we always talk about utilising basic allowances, so it will be one that I'm sure we'll push to use. And obviously, the more of a well publicised change was the national insurance, another 2%. I think, as I've said to a couple of people, I'm far younger than you guys, obviously, but
thank you.
I always thought national insurance was there as for state pension and for state benefits, etc., and it coming down over the last two budgets. But of course, I think these days it's lumped into one pot, isn't it?
Yeah, I mean, the important point to note that this is just for employees, first of all, not employers, NIC.
Yeah, employees and self-employed.
Yeah, thank you. So yes, and this is the second 2% cut we've had. Now, it's not going to help many groups of people, such as pensioners, unfortunately. So you can see perhaps why he targeted this at employees, NIC, rather than a headline cut in the rate of income tax.
Yeah, and it's more cost effective because obviously the income tax cut would benefit those of state pension, landlords, etc., etc. So it's less of a cut. One could suggest that maybe he's quite happy with the older generation from a, again, political viewpoint, and maybe securing those votes. He's less targeting those, but maybe going off track to the political content.
All right, we'll talk about the numbers a little bit later. So we'll come back and see how much that is actually going to save people. I was a bit nervous actually when he first started talking about this, because I thought he might go the other way and put NICs on dividends, which is something that's been talked about and would be a significant revenue raiser. Instead, he's suggesting he'd like to abolish NIC.
There was talk of that I was reading this morning, but then it seems to have been backtracked over the last and said it's not practical that could happen. So I think it's a watch this space and see what come out of it going forward.
Yeah, I mean, look, one of the things I would have liked to have seen is more simplification. Now, he's highlighted some of the abolition of tax reliefs that we'll talk about as a simplification in many respects, and you could say, yeah, that's welcome, or it's going to be unfortunate for some people who benefited from that. But it certainly would be nice to, I mean, there's so many little nuances between the different what's accessible for NIC and income tax. Surely there must be something they can do to make the tax system simpler here.
And going back to the original point, the national insurance nowadays clearly is not used as a separate pot for state pension, state benefits, etc. It's amalgamated into one. So if it's not being used that way, maybe we can get to a simpler method.
All right, I guess watch this space. But I think the big, from a tax perspective, announcement that was made in the budget is something that's been rumbling on for a little while here. Our old friend, the remittance basis, Terry. So why don't you just summarise where we were, and then we can talk about the changes that have been announced.
Okay. Well, I was personally devastated when I saw that it looks as if domicile is going to go as a connecting factor for taxation. Listeners who attended our December webinar may remember me talking about domicile being one of the things that the Romans gave us, along with central heating and all the rest of it. It's not possible to abolish domicile in the sense that it's a concept of private international law, and it connects a person with a particular territory for purposes, for instance, of validity of marriage and succession issues and so on. So the current position is that for .uk domiciles can be taxed on the remittance basis, where non-UK income and gains would be taxable only if they're brought into the UK. And the ability to be on the remittance basis for a non-domicile has historically been free for 7 years of tax residence. But if the remittance basis is claimed, then the person would lose their income tax personal allowance and their capital gains tax annual exemption. Now, of course, if they're people who have a high UK income, they would lose their personal allowance once their income goes over 100,000. So the income tax allowance may not be such a big thing. And then after 7 years, currently there's what you might call a club fee of 30,000 per annum or 60,000 per annum for a person who's been tax resident here for 7 out of 9 years or 12 out of 14 years. And at one point it was proposed to have a 90,000 per annum charge, but that then went when the deemed domicile provisions were changed with effect from April 2017. And one point to note under the current system is that even if you pay the club fee, you would still pay income or capital gains tax if you remit non-UK income and gains to the UK. And I just put a note on the slide, contrast the position in Italy, where somebody who's not been resident in Italy who moves there would have the ability to pay 100,000 euros to the Italian government and then not pay tax on non-Italian income and gains and could freely remit them. And then the last point on the slide is that whereas the deemed domicile provisions used to apply only for inheritance tax purposes, as from 6th of April 2017, a person is deemed domiciled for all UK tax purposes once they've been tax resident here for 15 out of 20 years.
Sorry, just flick the slides there, Terry. I'll just go back to where we were. There you go. So that's the current regime.
Yes.
Let's just talk about the changes. I'm just going to try and turn our microphone down. Some people are getting a bit of an echo, Terry, so I'm going to turn you down a little. Hopefully we can still hear you and everyone else will, but hopefully that will deal with the echo that some people have been commenting. Okay, Terry, so what's going to change now?
Well, what the government is saying, and a lot of this is subject to consultation, so of course it could change along the way. And of course, we will have a general election sometime this calendar year. So although in a sense, the Conservatives have pinched Labour's idea on changing the domicile basis, it may be that it gets tweaked before it actually becomes final legislation. But the current proposals, as I understand them, are that from 2025, there's to be a residence-based test. And as I was saying earlier, much to my chagrin, the end of domicile so far as UK tax is concerned. For people coming to the UK who haven't been UK resident in the previous 10 tax years, they will enjoy for 4 years here what we now need to get used to be called the FIG regime, the foreign income and gains. So for those people, there will be no tax on foreign income and gains for the first 4 years, and they will be able to remit them without tax charge. Now, those listening to the Chancellor yesterday may have heard him say that this was actually better than the current situation. And it is in the sense that, as I was saying on the previous slide, paying the remittance basis charge or claiming the remittance basis did not allow you to bring foreign income and gains in without a tax cost. So they will be able to bring in for those first 4 years. And if you've been UK resident for a period but haven't exceeded the 4 years on the 5th of April next year, then you can enjoy that treatment for the balance of the 4-year period. However, the notes say that if you do claim FIG treatment, you would lose your allowances, and there must be a joke in there somewhere about fig leaves that I'll need to workshop a bit more. Another important point is trust protections are going to be lost if the settlor is resident for more than 4 years. Most of our listeners, I'm sure, will know that when the 2017 changes came in, settlements that had been created by a non-domiciled settlor could be protected provided they weren't tainted by, in simple terms, additions post 5th of April 17, and provided the settlor remained non-domiciled at general law. And subject to those caveats, the settlor would only be taxable on UK income of the settlement as it arose, and would not be subject to income tax on foreign source income as it arose, nor would the settlor be taxable on any capital gains within the structure. They would what we would call stockpile, potentially to be matched with capital payments received, in simple terms, benefits received by a UK resident beneficiary. Those protections are going to be lost if the settlor is resident for more than 4 years, which is quite a significant blow. And that will affect a good number of our clients if the legislation goes ahead as has been mooted.
Yes, I think you're alluding to, Terry, this is all subject to consultation and finalisation, and once we've had time to digest this, we will, I think, do a more detailed webinar. But okay, talk us through some of the transitional changes, Terry.
Right. Well, if a person has been on the remittance basis and they then move to the arising basis on the 6th of April next year, they would be able for the following tax year 25-26, so that's the tax year after the current one, isn't it, to only pay tax on 50% of foreign income, but that's a 1 year only offer. And then there's also going to be the ability, if they go ahead as planned, for a person who has claimed the remittance basis in the past will have the ability to rebase assets personally held by them for capital gains tax purposes to rebase to the value at 5th of April 2019. So that would then effectively knock out from capital gains tax any gains pre-April 19. And as with other elections of a similar nature, you would have to take a view as to whether that was going to be beneficial or not, because it might be that by knocking out the period before April, you might lose losses. So it wouldn't be a sort of slam dunk necessarily to rebase everything. You will have the ability, if you're in that situation, you'll have the ability to pay tax at the special rate of 12% on remittances of pre-6th of April 2025 foreign income and gains, but again only in 25-26 and 26-27 when the special offer period will come to an end. But that's not going to be available on current thinking to pre-6th of April 2025 foreign income and gains in trusts. So it's quite complicated what's being proposed, and we must repeat the caveat that none of this is yet law. And now I'm hoping that Chris will speak to overseas workday relief. Please.
Yeah, I'll let Chris pick that up. Just Terry, any thoughts on where that 12% rate has come from?
It's half the new capital gains tax rate on residential property.
That must be it. Okay. All right. So
it's twice the 10-year charge rate under IHT on a relevant property trust.
Could be one of those. We'll give it a bit more thought. Okay, Chris, over to you. There's been some corresponding changes in overseas workday relief. Do you want to just summarise that, Chris?
I mean, there wasn't a huge change actually to overseas workday relief. They're actually saying it will still apply. For those that don't particularly know, overseas workday relief is an extra relief that's given for individuals that are UK res, non-dom, and on a remittance basis. And it essentially gives relief for duties for the first 3 years they come to the UK, for duties that are performed outside of the UK. So essentially you won't pay tax on that income as long as it's not remitted back into the UK. Now, the nice change that's come out of this actually is that you will be able to remit that money into the UK now, and there won't be tax. You'll still get relief. So that's actually quite positive. And thinking of certain cases that we have, certain industries and sectors and so on, that's actually quite attractive.
Okay. All right. Thank you for that. Now, Terry, you've been talking about domicile and its origins, and it's, my great colleague David Wiscombe used to summarise this. It's all about what cricket team you support, really, isn't it? You may move country, but if you still support the same cricket team, as it were. And if you don't understand cricket, then clearly you're not domiciled here. It's probably a little bit more technical than that, but it also applies for inheritance tax purposes, if not, it's even more important in that context. So we do need to consider what impact moving away, or the death knell of the domicile basis, will have for inheritance tax. So Terry, before you have a well-earned break, do you want to just talk us through sort of again where we are and what's intended to move?
Yes, of course. So the under the law as it stands at the moment, the scope of UK inheritance tax is determined by a person's domicile. So for individuals who are domiciled at general law within the UK, or those who are domiciled elsewhere under general law but are caught by the deeming provision, as I was saying earlier, from 6th of April 17, that changed to 15 out of 20 years. And in fact, that was only a 1-year telescoping because of the way the old 17 out of 20-year rule worked. So now we have deemed domicile, as I was saying, for all tax purposes, one's UK resident for 15 tax years. Again, historically, planning for non-domiciles before they became deemed domicile was the advice to set up what we would call an excluded property trust. And the key feature of an excluded property trust is that the settlor must be domiciled outside the UK and not deemed domiciled when the settlement is created, and also, and this for a while was a bit of a grey area, but the legislation was then changed, also not be domiciled or deemed domiciled when any additions are made. And under the current rules, provided that is the case, then non-UK situs assets in that sort of trust, and for the last dozen or so years, authorised unit trusts and open-ended investment companies will be treated as excluded property. So the trust would be outside the 10-year charge and exit charge regime applying to trusts nowadays generally. And a misconception sometimes is that people think that that excluded property trust had to be a non-UK trust. That's never been the case. They were normally set up as non-UK trusts, but because in those days, and indeed still currently, the non-UK trust settled by a non-UK domiciled settlor could enjoy income and capital gains tax benefits. Now, it's still the case that a UK trust could have excluded property status for inheritance tax purposes. And I've put a note on the slide, watch out for returners. This was a provision that was popularly supposed to be aimed at one particular banker who is supposed to have so got up the noses of a Treasury committee that they brought the provision in just to spite him. So if the settlement was made by a non-domiciled settlor, but a person who had a UK domicile of origin and was born in the UK, then if that settlor at any point resumes UK residence during their lifetime, that settlement will no longer enjoy excluded property treatment. And we did sadly have 1 or 2 clients to whom that applied. I think another shame with the domicile going is that we only have something like 10 or so inheritance tax treaties with other countries, and 4 of them are old. France, Italy, and more relevantly, India and Spain are old treaties. And the treaties with India and Pakistan, I think I might have said Spain, I was thinking about my holidays. The treaties with India and Pakistan can be particularly relevant because at best, the effect is to disapply the deemed domicile provisions if you have a client who's domiciled in India or Pakistan under their domestic law. And well, there's a bit of a grey area here as to whether they have to be domiciled there under our law or merely not UK domiciled under our law. Then in those situations, regardless of how long they've been here, the effect of the treaty can be to disapply the deemed domicile provision. So in theory, you could have an Indian domicile who's been UK resident for 40 years, who could escape UK IHT on their assets outside the UK, provided dealt with by a non-UK will. And it seems to me that sadly that treaty treatment will go if domicile is no longer going to be a connecting factor for inheritance tax purposes.
Okay, thanks, Terry. So talk us through what's expected to change now.
So the current proposals are that the new scope of IHT is no longer going to be based on a person's domicile, but it's going to be residence-based, and the person's assets worldwide will be within the scope of inheritance tax if they've been UK resident for 10 years. I mean, note this is a longer period than the 4-year FIG period. So that's if they've been resident here for 10 years. Now, what if they leave the UK? Well, currently they're talking about a 10-year tail if they went non-resident. So on the face of it, they would have to cease UK residence more than 10 years before they were proposing to, as it were, shuffle off this mortal coil. There's going to be consultation and legislation later this year. One point we haven't put on the slides is that in certain circumstances, government securities can be useful in tax planning because, again, at the moment anyway, they can be free of inheritance tax in the ownership of a person who's non-UK resident. So it might be that gilts would come into their own if, say, I've been 10 years resident here and then I go and live in Monaco, say, I would have the 10-year tail. It might be that if I put the bulk of my considerable wealth into certain government securities, I might be protected from popping off prematurely. Anyway, we'll see how that might fit in with the legislation. How will excluded property trust be affected? Well, I think they're saying, and I think this, Tony, if you didn't mind, move on to the next slide. Beg your pardon.
Nope.
Yes, no. Oh, sorry. Can we come back to number 3? Can we go on to number 4, please? Yeah. So they're saying that within a trust, UK situs assets would remain in scope as now. I mean, that makes perfect sense to me. But they're saying that it's still going to be possible for a non-domicile, non-deemed domicile to create an excluded property trust before the 6th of April next year. So I was saying earlier that historically that sort of trust would normally have been outside the UK, and I now wonder whether it might make more sense, given that it may not offer income tax and capital gains tax protection. Maybe it would be better if it was a UK trust, because that would be cheaper to set up and cheaper to run than a non-UK trust. But I think we're back to watch this space on that one. They're saying that excluded property treatment will still trump the gifts with reservation of benefit provisions. Again, for a long time, this was a grey area. So if I was a non-domicile and I'd created an excluded property trust and I was a beneficiary, then there was a bit of a debate as to whether that excluded property status trumped the reservation of benefit provision if I were to die while still a beneficiary. I have seen some sad cases where that sort of trust holds residential property, and in those cases, on the 6th of April 2017, the value immediately became exposed under the GROB provisions if the settlor was still alive. And the one very sad case, the settlor died only a day or so after the 5th of April 17. So they're going to consult generally about these changes and also how they will affect formerly domiciled resident settlors, the people I've been calling returners. But then, having said all of that, the Treasury note says tenure and exit charges may depend on the residence of the settlor. And I was lucky enough to attend a talk by Giles Clark, who's one of the authors, along with James Kessler, of weighty tomes on non-UK matters. And he was very prescient in that he said, when asked about what a change of government might do, he said that it might be anomalous if you had an excluded property trust and all of the family were resident here. So this may be that sort of change. And he also made another prediction, which I'll come on to shortly. That's probably quite enough from me on trust. Might we go back to slide 3, please, Tony? If we could go back one.
Yeah, I think Chris just wants to add a
No,
comment.
I think it was just going to be a
Chris.
summary point, Terry, with it. That there's a lot of detail that obviously we're still yet to establish what's going to happen, but there's clearly going to be planning points to put in place here, whether it's on the non-domicile position or from the income tax point of view, CGT point of view, or from the inheritance tax.
I mean, certainly,
and I think we've got a little. What's fortuitous, we've got a little bit of time to be able to do this.
Yes, certainly our listeners and their clients, you would want to be reviewing your clients who are not domiciled within the UK at general law and are not yet caught by the deeming provisions, with a view to seeing whether setting up an excluded property trust would make sense for those people. And as far as we know, we would have until the 5th of April next year to be doing that. I think the difficulty is going to be sort of act in haste and repent at leisure. So you would probably want to have your ducks in a row, but maybe don't press the button until the legislation's at least out in draft form. Anyway, I'm sort of conscious of time, so if I canter through very quickly these other IHT changes that were announced yesterday. So agricultural property relief is going to be restricted to UK situs land from 6th of April next month. At the moment, certain assets within the European Economic Area. I mean, this is another benefit in quotes of Brexit, I suppose. The same for woodlands relief. Woodlands relief, I'm not sure I've ever actually seen claimed, because you would normally be wanting to go for business property relief on commercial woodlands. Business property relief, no changes as far as we could see announced yesterday, and still no territorial restriction. I think Chris is going to speak about furnished holiday lets. Just one point, normally no business property relief because the courts regard them as investment in nature. No business property relief for investments. The regime is going to be abolished from 2025. Taking aim, this is the alternative investment market. No relevant changes yesterday. It might be a target for a Labour government. We don't yet know. Again, previous listeners may have heard me banging on about the fact that pre-April 96, you had to have a minimum of 25+% of votes in an unquoted trading company to get the higher level of relief. Easier to get a grant on credit. One poor chap had emailed me a little while ago saying that his firm was providing credit to executors to enable them to get the grant, because HMRC have always been very difficult to persuade that a grant on credit. This is the ability to get a grant of probate without coughing up all of the inheritance tax that's due. And I remember I started my career in what was still just the estate duty office many years ago, and they were very resistant then to allow grants on credit. So apparently that's going to be easier to do. And I think I read that you're not going to have to prove that you've sought commercial borrowing in order to apply. So I think that's quite enough from me on inheritance tax.
And it's not quite the end of you though, Terry, is it? Because we're just going to say a couple of words on transfer of assets
listeners
abroad.
To hear that the other Giles Clark, again, as I was saying, he was very prescient. So the Fisher case was quite complicated. In simple terms, it was a gambling company who moved some of their operation to a Gibraltar company. And it reached the Supreme Court, who decided in the taxpayers' favour. So the sort of running order was first tier tribunal, HMRC won in 2014. The upper tribunal, the Fishers, won in 2020. The Court of Appeal, the father and son lost, but the mother won in 2021. And then the Supreme Court held in favour of the Fisher family. And Giles, on the 20th of February this year, said that he thought they might reverse Fisher by legislation, and that's what apparently they're going to do. So in that case, it was a company that had made the transfer, and the argument of the family was that how could they be the transferors when the close company was the transferor? So they're going to introduce rules to frustrate that. But then looking at the impact, they're saying that it's going to generate 10 million in 25-26, 5 million the following year, and thereafter a negligible benefit. So I think I may be missing something. and slightly provocatively, I've said, why are they bothering for such small potatoes?
All right, thanks, Terry. So yeah, I think it was interesting. The judge actually invited almost HMRC to amend the law and said, if you don't like it, please do. And that's exactly what they've done there. So, OK, thanks, Terry. You can have a lie down now while we
thank you.
Move on. We're going to talk now about property taxes. This is a sector that's been hit quite heavily over the past few years. Some good news and bad news here. Chris, take it away.
Yeah, well, I think this was a nice, pleasant surprise initially, wasn't it? On the first point being the high rate of capital gains residential property reducing from 28% down to 24%. I must admit, I can't recall or seeing a reason, not hearing the reason why he thought that was coming about. He normally has a bit of a speech before it. So that was actually a bit of a surprise, maybe linked to the next point with the furnished holiday lettings regime that's going to be abolished. I think the main one might be connected because of the business asset disposal relief. For those who aren't aware, if you've got the furnished holiday lettings, which is essentially a property with short-term lets, nowadays it's akin to more of the Airbnb properties. It used to be more of the put towards the properties in Cornwall, etc., and just the short-term lets. But the advantages going back were that it was treated more as it was treated as a business, and initially you could have the sideways loss relief, which was losses against other income. That went a few years back now, so it left us with the main positives being the unrestricted loan interest relief, which, given the way interest rates have gone in the last year, that's advantageous, and the use of capital allowances, and then of course the business asset disposal relief, so effectively banking a 10% capital gains tax rate on exit. So abolishing the regime, they've gone. That's it. It pulls it back into restricted loan interest and a capital gains regime, which would have been at 28% down to 24%. So maybe that's the sweetener. Again, reading bits and pieces in the press today and conversations we were having yesterday, targeting maybe the areas that are under contention from a political viewpoint, where we've got holiday lets down in Cornwall and people can't buy property there, etc., because of short-term lets. Maybe it's hitting a pin with a sledgehammer. I don't know.
Yeah, perhaps. I mean, I think we'd welcome the cut in the rate of CGT rates. It's never quite been clear why sales of residential properties should suffer a much higher rate of CGT than any other asset. So, OK, it's a step in the right direction. I think if you are an investor in property, though, one of the things you won't welcome is what's on the next slide. Got it right there, is the abolition of multiple dwellings relief. So this is where you bought more than one property. You could base the SDLT on the average price for the property rather on the total price for the two properties. And because of this sort of system of marginally higher rates of SDLT, it could save you significant money. But as always, I think from HMRC's perspective, there was a view that people were seeking to take advantage of this relief, particularly the so-called granny annex, where you had a little granny annex built into your house. People would argue that was two properties, not one, and therefore you would pay SDLT when you bought the property with the granny annex, based again on the average price for the two, as it were. It wasn't quite what the legislation was designed for. It's always very subjective when you start talking about fairness in tax system. But anyway, whatever reason the revenue have, it's going from 1 June 2024 with a few transitional rules if you've already exchanged. It's not all bad news, as it were. If you are buying more than 6 residential properties, you still have the choice to apply non-residential rates to that purchase, which are typically, well, again, it is banded, but works out about 5%. So that can still save you significant money. The difficulty is if you're buying between 2 and 5 properties, that option isn't available to you. MDR simply goes, and you might have a much higher SDLT charge than you were anticipating. So not good news. I guess on a more positive note, the rules governing mixed properties have remained unchanged. Again, there was, I think, a view in HMRC that these rules were being abused. If you were buying a property and it had, for example, a footpath within the property, people were arguing that wasn't just solely residential, it was mixed use, and therefore could I have the non-residential rates? Well, watch this space, I guess, but for now, those mixed property rules remain unchanged.
One of the points, Tony, that I got asked last night actually from clients, because this is close to election. People are asking, we get this budget and we're told of these changes. Are they going to be enacted by this government, and what's the chances of these getting reversed very quickly? Just for the listeners out there, and what's your view on that?
Well, I think they will be enacted. I suspect there'll be a very quick finance bill and process through the relevant houses, and they will be passed. I guess the real question is, will there be another budget before the election, and when will that election be? Very possibly, I suspect. We've clearly had a few sweeteners from a tax perspective here. Whether they'll try and push through some other changes. I mean, we've had talk of abolition of IHT, haven't we, Terry, for a long time, but it's never happened. We'll have to wait and see. But I would expect these changes to go through. Whether they'll have the opportunity to put through any further changes to try and entice voters back, we'll have to wait and see. Just one other point on the SDLT, there's one other quick technical change. First-time buyers relief on the grant of a lease where a nominee was used. This did create a few anomalies. Going forward, they'll now look at who the beneficiary is. If the beneficiary is the first-time buyer, then you should get the benefit of first-time buyers relief, subject to all the normal conditions. Under existing law, you had to look at the status of the nominee, so you could get unexpected results there. So that's stamp duty, land tax and property tax generally. I'm now going to focus on business tax. And again, I think a lot like income tax, a lot of the changes we've already had. Yes, there have been no changes in the rate of corporation tax. We've got a headline rate now of 25%. Small businesses may benefit from the old 19% with marginal relief in between and adjustments for numbers of associated companies. It's all a bit depressing, really. But bear in mind, we were expected or told to have that we would have a 17% rate of corporation tax not so long ago. So the swing is quite significant, albeit I guess the Treasury would say UK rates remain still vaguely competitive. It is what it is. So no changes to that 25% rate. Capital allowances remain unchanged, but we'll talk about those in a minute. I've just highlighted there, we did the webinar, as I say, just a few weeks ago on R&D. There are significant changes coming in there from 1 April 2024. We're going to see the merger of the small and the large companies regimes. That said, there is still this standalone regime based on the old SME regime if you are what's known as an R&D intensive company. So again, the frustration is, as much as I think most of us welcomed the amalgamation of the two regimes, we are still going to have this old regime hanging around for the foreseeable future, which will be relevant for loss-making companies that, as I say, are R&D intensive. We're going to have the restriction on overseas expenditure that applies from 1 April 2024 post-Brexit. And there is now a new definition of what we mean by subcontracted R&D for these purposes to try and clarify who retains the entitlement to R&D when it's subcontracted from one party to the other. Okay, so that's all we're going to say on that. As I said, we'll come back to capital allowances in a minute. What I wanted to do now is just go back to the point we started with, really, which are the changes in NIC rates. Because although we're talking about business tax, this is very, very relevant to owner-managed businesses. How should you remunerate yourself? We've still got the old choices of salary, dividend, or perhaps even remaining self-employed, and each of those have different tax consequences. But if we just have a look at the changes in NIC rates, Chris, do you just want to talk us through this?
I'll talk you through it. The facts are there. Ultimately, we're looking at normally or up to a £754 saving for individuals. It's more for self-employed individuals. And as we said earlier on, we've had a double hit of NIC reductions over the last, what's it been, 6 months or so now. So a welcomed reduction. And noticeably there wasn't a reduction for the employers. I mean, you just touched upon bits and pieces on the business tax side. And I think, again, noticeably, there was very little thrown out there for this time round for businesses as a whole. I thought they would have expected something thrown out for national insurance. But you know, the facts are there on the screen. and it's a welcome reduction.
Yeah, so 754 is the maximum saving an individual will make who's employed, given the cap on employees' NICs. The figure of £900 has been bandied around as the savings. I think that's the total savings of the two changes for an average earning employee. So someone who's earning, I don't know what the average is, around 40 odd £1,000 this year, but you know, £900 in your pocket to be welcomed, I guess.
Tony, just interrupt you
Yeah.
because there was one question that somebody did actually ask about furnished holiday let.
Okay.
And would they be able to sell their furnished holiday let before 6th of April 25 and get incessive disposal relief? Which, yes, I mean, I don't see why not at all. It change isn't due till after, so you've got a little bit of time to plan an exit. I mean, like most things with any potential sale, I think we need to talk first to make sure we picture how that looks. But absolutely, the opportunity's there. Maybe, you know, this is be push a little bit of them might push the property market and force a few sales through.
Okay, all right, thank you for that, Chris. Just coming back to where we're at NIC, just to visualize this. I've gone the wrong way again. Where's it gone? There we go. So hopefully you can all see that. The red line is the rate of tax if you're self-employed, and that generally gives you the best rate of tax, doesn't it, Chris? Simply because there's only one layer of tax there.
Indeed, yeah.
So, but it's not for everyone being self-employed. You do need to think about the commercial issues. You've got potential unlimited liability there, God forbid something goes wrong. But simple structure, no need to have annual accounts, etc., etc. Still got to pay a tax, would be the best rate. Green is effective rate for dividends. And what this graph is showing, if you compare that to the sort of bluey grey line for salaries, you're probably better off taking a dividend. Certainly up to around £230,000, there is a tax saving there for most employees. And of course, there are further planning opportunities there. If, for example, you were to split your shareholdings with a non-working spouse, or if you had children who were over the age of 18 and you could give them shares, we can spread that tax over a wider tax base. So as always, you know, the devil's in the detail. We need to think about it. But I think taking into account current rates, still generally dividends are a winner, with one notable exception. Banging my old R&D drum again. If you are actively involved as a director on R&D, it is possible to get the uplift in your salary costs as part of that R&D expenditure credit. So that may skew the equation back to taking salaries. Again, we need to look at that on a case-by-case basis. But I think as a headline, Chris, would you agree? For most people, dividends are going to be more effective.
Yeah, I think, as you said, as a headline, yes. Even our slide there's got some broad assumptions in. So you do need to be still looked at on an individual basis, without a doubt.
And we can happily do that for you. And we've included a table there. We're not going to talk through that shows some of the individual calculations. We will be sending this out to you all. So have a look at that. When they come out. Thank you to Lola and David for organising that. So I'm just going to come back now to capital allowances, because one of my bugbears when I started this job many years ago, I had 2 yellow books on my shelf, and I'm now up to, well, I've got 5 there. I think that's all of them. We've got 2 orange books as well. The system just keeps getting more and more complicated. Where are we on capital allowances? Well, we've now got full expensing, which means a full write-off of main pool assets and a 50% deduction for special rate assets, 6% writing down for the balance from April 2023. But that only applies to companies, Chris, I think we should highlight. But bear in mind, if you dispose of any of those assets on which you claim full expenses, effectively they're treated as depooled. You bring all of the proceeds into the charge to tax rather than deducting them from the carrying value of your pool. One other announcement was made yesterday, although the rules are staying, I meant to say, it is proposed that assets acquired for leasing out will be able to benefit from full expensing. That's subject to consultation, and the Chancellor said, I think, when government finances allow. So, well, hold your breath on that one. So we've got full expenses. Yes, I think it's good news, and the Chancellor, I think, tried to make the point that this is a great incentive for businesses to buy in and invest in plant machinery, equipment, etc., etc. But it is all getting rather complicated because we've still got our old friend, the annual investment allowance, that certain partnerships purely of individuals, for example, can qualify. The rate's gone up and down for many a year. It's now been set permanently at £1 million. That £1 million is for broadly all the companies in the group, though. Why might you go for AA rather than full expensing? Well, that's because we don't effectively have this depooling on a disposal. So go for AIA, and also if you've got assets in the special rate pool, you'll get a full 100% write-off rather than the 50% under full expensing. So you need to consider the interaction of that. And we've also got first-year allowances knocking around. No upper limit on expenditure, and this covers electric cars and low emission cars. I think it's up to 50 milligrams per kilometre, isn't it, Chris? Chris is vaguely nodding at me. All right, we'll check that point. Electric charging points and a few other assets that are out there. So 3 different capital allowances regimes you need to consider. I mean, one of my colleagues was asking me about cars used for hire yesterday, and we had to look through all of these separate regimes to come to the answer. And it was quite prescient because on that very day, the Chancellor had announced that such assets could potentially in the future benefit from full expensing. So that's capital allowances. As I say, not a great deal of change, but I just wanted to highlight all the different thought processes we needed to go through. There were also a number of changes to some of these, excuse me, tax incentives, theatres, orchestras, etc., etc. I'm just going to summarise this really. The rates have moved around. They were due to drop again, but now we've been told they are permanently going to be set as at the rates on that slide. So for theatre tax credit, there's different rates depending whether you're a touring or a non-touring production. 40% for non-touring, 45% for touring. You can see the rates there. And the other point, just to highlight, the museum and galleries exhibition tax relief is to be made permanent. Well, that's good news, isn't it, Chris? Can't say we see too much of that, but okay, we'll take it. Back to my old friend on R&D, we have been moving more to these above the line credits, and that's also highlighted by this new independent film tax credit that's been announced. Listen, we all love a good movie, and these rules are designed to encourage filmmaking in the UK, that I think we'd all welcome. There's a whole load of new production studios going up around this area, isn't there, Chris?
Certainly around this way.
Yeah, Sky built a huge one. There's new ones up in Mill Hill, I noticed. So it's clearly, I think, having some effect. So this is to encourage small films with a production budget of up to £15 million, must be BFI accredited. So they want a UK writer or director, or be certified as a UK co-production, and it must be culturally British, whatever that means. You've got to eat fish and chips, have a pint of bitter, I don't know, but be about British things, basically. Applies where the principal photography is after 1 April 2024. And if you meet all of that, although you won't be able to claim till 1 April 2025 for whatever reason, there'll be a 53% credit available for your qualifying expenditure. All rather complicated. What's qualifying expenditure? This is 80% of your core expenditure. And what's core expenditure? That's expenditure on the actual production activities. So it excludes marketing, interest costs, etc., etc. The costs of actually producing that show. And the credit is itself taxable because it's one of these above the line credits. So I think welcome. And hand in hand with that, we've got the new audiovisual expenditure credit. So this is trying to bring together some existing film, animation and TV incentives. It will apply from this year, subject to certain transitional rules. Excuse me. And again, it's an above the line credit. When we were first told about this, it had differing rates. Some was at 34, some was at 39%. It's all going to be at 39%. And again, back to the previous slide, it previously was based on 80% of your qualifying expenditure. That cap is now going. And there is a consultation to define exactly what costs will qualify for these tax breaks. But if you're in film, animation, TV, I think we'd welcome this, albeit it is quite difficult to keep up with the changes. So those were the main points I wanted to highlight. No significant other changes. We always pause for breath, don't we, Chris, when there's a budget, because it's not so much what the Chancellor says and announces. The devil's usually in the publications that come out and loads of subtle anti-avoidance, etc., etc. We haven't seen much of that at all, really. So I think we just wanted to finish the webinar just highlighting some other changes. VAT, not much to say on VAT, apart from an increase in the VAT threshold from 85,000 turnover to 90,000 from 1 April 2024. Intended to help small businesses. I think, you know, you could argue, is it a disincentive? Do businesses think, well, I don't want to be registered for VAT, I'll just keep my turnover just below that? Well,
the general thought, I mean, general thoughts on that is that's still a low number. I mean, obviously the 5,000 increase is a low number. It's not going to do much intended to help small businesses. You know, I just wonder out there whether that should actually be a lot higher. Should we be, people be pushing for that to be 150,000, 200,000?
Well, very possibly. And I think the point has been made, you know, these rates have not kept up with inflation. Inflation's been pretty high over the past few years. And you made the point before about the increase in the child benefit higher income charge applying not at 50,000, but that's been moved up to 60,000, which again we'd welcome. But again, it hasn't moved a dime from 50 grand since it was first introduced, has it? So, look, I guess, you know, the government has to balance the books, and we've got all the COVID support to pay back. So, you know, I'm not here to take a view and to make a view on that, as it were. But it is what it is. But OK, it's going up, I guess, some welcome. And as you can see on the slide there, the deregistration threshold when your turnover drops and you have to deregister VAT, that's gone up from 88,000 from the previous figure of £83,000. And then finally, just some admin and other measure points to mention. The government is consulting on strengthening the regulatory framework and improving registration of HMRC. So that's people like you and me making sure we do our job properly and are properly qualified. Not quite sure who's going to regulate unqualified accountants and tax advisors, etc., etc. I think that's a much broader discussion to be had. It's interesting, again, going back to R&D, I think the suggestion was there are a number of unregulated firms out there who are acting somewhat unscrupulously, and I think HMRC are just putting us on notice that they are thinking about whether you have to be formally registered in some capacity in order to give that tax advice. So we'll see what comes out of that. They're also going to put £140 million in debt management capacity from next year. So again, I guess, watch this space, but they're going to be coming after people and trying to organise their own affairs a bit more professionally. Similarly, investment in HMRC digital services to be implemented from next year to support self-assessment taxpayers. Well, let's hope it's not called Horizon, I guess, Chris.
I mean, one of the bits I don't think we got this time round was the investment in to raise inquiries, etc. I think that was announced in the last budget back or autumn statement in November, but it is a key point that we are seeing revenue activity, the queries, the IT systems that are pumping out automatic inquiries that link in across all areas of the business and just putting general queries out. That's definitely been an uptake. So I think some of this investment going in, it will slowly filter through, but they're automating a lot of systems, which it can be quite difficult to then communicate back with the revenue. I think a real proactive point there, actually touching upon, is the fee protection service and making sure, certainly with any compliance matters, whether it be corporation tax, VAT, personal tax, that people do take up the fee protection side, which is essentially cover for any professional fees when there's a query coming in from the revenue, because these points are suggesting those queries will come even if you're using a good advisor such as ourselves and are perfectly have everything in order. I think the queries still may come.
Okay, and we like to end on a positive note, so let's just talk about now. Now you drive an electric car, Chris, don't you? I mean, drive in the broadest sense, I have to say.
I sit in it and press the button and let it take me to the destination.
So you may not be aware of this, but petrol's now about what, 140, 150 a litre, of which I think 53 pence is duty. It's now been frozen, I think, for over a decade, although, I mean, I shudder to think what petrol would have cost if it wasn't for that. So yes, it's welcome that it's frozen, but if you take into account the 53% duty plus the VAT, we're still all paying a fortune in hidden taxes, as it were, there. And Terry, I'm not one to cast dispersions, but I'm guessing that the freezing of alcohol duties must have made you a very, very happy man yesterday as well.
Yeah, despite being teetotal, as I said at the beginning of the talk, yes, yeah, something of which to approve.
Okay, so that's us. We will circulate copies of these slides, and Henry's asking about CPD certificates. Oh, good question, Henry. I'll check about that, but we'll see what we can do there. Thank you all for joining us. I hope that's been helpful. A couple of questions, apologies, we've not quite had time to come around to, but we'll see if we can respond privately on those. If you've any questions, do come back to us. There are our contact details. I've also put a link to our budget analysis on our website, written by David Wiscombe with his own unique take. So do take a look at that, or by all means speak to your normal contact at BKL if you'd like any further advice, input, or have any questions on anything we've raised today. And as I say, we will go away and digest all the new proposed legislation on non-doms, etc., with a view to perhaps having a more detailed dive into that once those provisions are more clear. So watch this space. But for now, thank you all for joining us. I hope you found that helpful, and take care. We hope to see you soon. Bye now.
Bye, everybody.